This is Justin Pulitzer. This is my weekend review video for Sunday, July 10th, 2016. Holy cow, it has been quite a couple of weeks. We had the lead up to Brexit, the Brexit, and then the recovery, quite tumultuous. Let's dive right in, a lot to cover. First and foremost, let's talk a little bit macro for the backdrop. We had an ISM service number that was, I wouldn't say amazing, but it was good enough to kind of hold off the recession, the immediate recession fears. And then we had a big NFP number, non-farm payroll number, the jobs number on Friday, which was big. I mean, it was a huge beat, much better than expected, and that's on the heels of a pretty crappy couple of jobs numbers the last couple of reads. I know everyone was very excited. I think it definitely takes, again, another feather in the cap of the no immediate recession imminent camp. But the numbers were good, but I want to go into what's behind the numbers. A lot of the jobs were, again, part-timing in the service industry, waiters, waitresses, bartenders. I often say I'm jokingly talking about carnival ride operators, but it's really a number. It's actually part of it. You know, with the way the market rallied on Friday, you'd think that carnival ride operators, dating carnival ride operators is now like dating the new lawyers and doctors, right? Because they're the only people employed. I hate to sound snide, but it's really kind of the way I see things. The AI and automation is starting to really eat into supply chain jobs, manufacturing jobs, particularly with outsourcing and offshoring. These are the only jobs that are available, and this doesn't really make for a confidence-inspiring economy where people can build careers off of. Anyhow, let's couch that for a moment. The immediate take, though, is that it basically puts the imminent risk of a recession off the table, and the numbers aren't really great enough given the backdrop that we're in, post-Brexit world, dollar rallying, for the Fed to kind of want to get jiggy. So the VIX, obviously, we had this pop-up. I talked about us being in a period of kind of more benign volatility with periodic pop-ups and then kind of waters receding. That's exactly what happened here. We had the benign period, the spike up, come down. We did have a close above 25.20, but it was very brief and unsustainable, and we have come down quite low. We're getting into the lower end of the range. Yeah, of course, it's possible we get down to the 10s and the 11s, but kind of betting on that, if you had to go to like a casino and place odds on it, you're talking about, not the 5-to-1 return tables, not the 3-to-1 returns. These are more like the 1-to-1 and 2-to-1 returns, probably even closer to 1-to-1. So yeah, it could come lower, but we are getting into the lower end of the range, and you probably want to look to maybe be careful in the sense that you don't want to be selling premium, really. If you look at my key, we are in purely directional play zone here, meaning buying calls, buying puts, buying call spreads or put spreads or what have you. It's not the period where you really want to get aggressive with selling out of the money premium. That time was up here. Anyhow, let's talk about where the VIX might go here. Like I said, could see the range low. Also very possible that this gets jiggy and pops up if there's some type of a pullback. Probably not going to get one of these moves again. It's not that common to have that type of an extreme move. You could see after these pops, you've had periods of more benign trade. Here you had the big spike. It came down, chopped for a little while. So we might be into chop for a little while phase. And then there's, some periodic flare-ups again. So that's kind of what I'm thinking is going to happen. And there could be some chop for a little bit. The dollar. So this, it seems like we're in a currency war, but maybe we're the only ones who don't realize we're in the war. Because Asia and Europe, they all seem to know, what's going on. Dollar, however, has been weakening quite substantially. Still in this range. Anything below the 200-day here to me is more vulnerable, meaning that you can see it's supported here supported, and here it was unsustainable to the upside, and we can see the 200 has been resistant. So I will say the dollar isn't something to really get yourself too concerned about unless the 200 gets taken. If this full range were taken along with the 200, I think we could maybe see the upper end of the range, and that might be a little bit troublesome for the equities. So got to keep an eye on the dollar. It's very important. Why? Companies that do business overseas have to deal with repatriation, and when the dollar rises, it becomes less profitable. That is, by the way, one of the reasons why the British stock market, which everyone had said the end of the world if we get the Brexit, nope. Their exports and their real estate market are probably going to experience quite a boom. Foreign investment coming at some point. I know a lot of people are worried about building plants and property and equipment there because they don't know what the situation of the UK is. But I was thinking to myself the other day, what would be the best way to play this? And honestly, the best way for me would be to go over, take a flight across the pond, and maybe buy a flat. If the dollar's going to be increasing, the pound's going to be decreasing, and you probably get property value appreciation as well as the currency exposure. That could really be the ultimate way to play the Brexit. Anyway, keep an eye on the dollar. Companies that do a lot of business overseas would be not so happy if the dollar starts, really rallying. That could also be a little bit of kink in the pants of oil, but we'll get there in a little bit. The bonds. I don't know how many weeks I can say the same thing. I guess I sound like a broken record already, for crying out loud. There is a way of valuing stocks. It is known as discounted cash flows, and a part of that component is the discount factor, also known as the weighted average cost of capital. For those interested, in the description below, there will be a link to a NYU site with a spreadsheet. You can play around with the risk-free rate in there and see the results of falling or rising interest rates. So I've proposed that the stock market is trading very rich right now. It is probably trading 19 to maybe 20 times earnings. I think when I first started this, it was like 17 to 19. Now I think we're probably closer to 19 or so plus. The market tends to top and have an unsustainable, first I want to just preface this with, a lot of people say 15 is the right multiple for the market. That's the long-term average of the market multiple. To that I say not true, disingenuous at maybe at best, incompetent. I'll just say this. The market tends to be unsustainable when it trades at below 10 times earnings and unsustainable when it trades above 20 times earnings. That is based on the model, I guess, that has governed the stock market for decades, centuries. The exception is the period we are in now. Why? We are in unusual times. Never before that I'm aware of have interest rates been as low or negative as they are now. When the market peaks, like I said, when it gets to be above 20 times earnings, interest rates tend to peak at 6%. The market as it is can't even hold on to 2%. We're struggling. If you look at Friday, interest rates made a new all-time record low. That is really quite impressive. So when I was talking about the weighted average cost of capital, the correct way to think about this is if you have a numerator and a denominator, meaning a simple division problem, the larger the bottom number, the denominator, part of that is the weighted average cost of capital, the lower the end product will be. The smaller the denominator, the larger the end product will be. That is the proper way to think about PE multiples and the premium or discount that they should trade at. This is up quite a bit, getting close to some resistance here, upper channel. So this doesn't necessarily need to completely collapse. It just needs to, I think, bide some time. If this does pull back, it doesn't necessarily mean the market is, going to be in free fall. But what it does mean is that interest rates, as long as they remain low, the market gets a PE multiple premium. If you start getting cascading effects like this, the market will not like it. If you get something more gentle like this, the market will be okay. Anyhow, we are getting to the upper part of the channel. We are kind of in a channel within a channel. I think that you probably want to be looking to take some profits and maybe take some right or right out short trades as we approach that upper area. It is very possible that there is an overshoot, but this is kind of going to be Custer's last stand in my view for a pullback. Like I said, if it doesn't pull back super duper aggressively, the market will still be in PE multiple premium trading territory. This, I think, gets a lot of people worried that there is a recession brewing. I think that's not necessarily the right way to view this. That, again, is based on traditional models. When interest rates go down terribly, it is viewed as a leading indicator for a recession. I believe that the reason rates are down so much is because of what is playing out around the world. You have a Brexit, you have instability pretty much in all over the world. Most banking systems don't have FDIC insurance, federal deposit insurance, meaning if the bank goes under, you could not get your money back. In the United States, we have that. That is one of the provisions to guard against a banking crisis, actually. In 1929, there wasn't that set up, and that's why you had so many runs on the banks. The good news is the United States does have that, and we also have a little bit of a yield. If you go into some of the European, like Germany, for example, they have negative yields on rates on bonds, because people aren't putting their money in the banks there because of the lack of FDIC insurance. They are putting them into the treasuries, their version, the bunds, because they know the government is likely to pay back the money. However, if you do have a currency that is falling over there, there is less value in those investments. So people are putting them into the United States, where the currency is stable, and where you have either a rising bond market or one that you can get in and out of fairly easily with liquidity and not have to worry about moving the price on yourself. So again, like I said, when you're very wealthy, you only have to get rich once, as a lot of people say. And when you're rich like that, you don't necessarily worry about a return on your capital, you worry about a return of your capital, meaning you don't wake up one day like they did in Greece and the banks aren't open. That is always the great fear. So the best place to do that is in the U.S. Treasury market. Like I said, getting a bit extended into some overbought territory, good area to start booking some profits. But like I said, just because this peaks, it doesn't necessarily mean a market crash or collapse. It just means that this needs to kind of hold high, stay high all the time, like that song says. If you start getting this, again, I don't want to repeat myself too much, but that is really the issue. The other thing the Fed looks at is the HYG. The good news with this is that, first there's good news and there's bad news. The bad news is we're getting into some resistance. The good news is we're making higher lows and higher highs. That is always a good pattern. And when we talk about, some people will ask me, I get a lot of questions on the stream, and I don't know the backgrounds of the people who ask me this. I don't know how long they've been market participants. But my experience is this, and I've been trading for a while. I've been trading since I'm a teenager, so for 20 years almost. My experience has been this, and from my readings of history, when you get crashes, when you get peaks in markets, when you get the 2008, 2009 scenarios, it's when there is a contraction in liquidity, when people can't take margin to support positions, when people are strapped for cash, they need to liquidate positions to free up money. That is evident in LIBOR spreads. There are, we all know about credit default swap, CDS. And even as Brexit was in its most heinous throws, you never got super-duper crazy spikes in CDS. Yes, it was elevated. Yes, it did get a big move, but it didn't get crash-type move. The kind of the layman's way of playing this would be with HYG, because these are the high-yield bonds, I guess can be used as a credit proxy. When the market really was in its kind of bad phase, when you had, flash crash type of thing, this is the fear. When you get this amphilotic, week after week, month after month type of selling, that's when credit seems to be getting to be a problem. Here, we seem to be in a recovery phase. That is good. As long as we can be in recovery phase, and let's use the 200 here, MA, as a gauge, I think it can kind of be okay. You could see when this broke, we couldn't really sustain over the 200-day moving average. We got close a few times, couldn't kind of hold it. Here we've been doing an all right job. So I wouldn't get too nervous with regard to credit until you really start seeing a 200 MA break, or you start seeing lower lows with lower highs. You see, like this pattern: lower high, lower high, lower high, lower low, lower lower, lower low. Wow, who thought that would be a tongue twister, but it became one. Anyway, the pattern here seems to be with I guess kind of glossing over the noise here. The pattern has been stability and recovery, which is good. We are roughly about halfway back to from the peak to the trough. We're coming into some more, I guess, these were sort of more the breakdown levels. So we'll see where the rubber meets the road here. We're coming right into it. It wouldn't surprise me to see if there's a little bit of a back off, but this pattern doesn't exactly strike me as credit crisis worthy. Oil. So we got into the resistance that I had talked about, 49 to 52. That did it, 51.67. We have been in a controlled pullback. This chart is moving because oil is actually trading. That is very annoying. We're making lower highs and some lower lows, so that is one of my big concerns for the market in general. Algorithmic trading has been, with the exception of Friday, and I remember I said I'll let you know when things change. The reason I don't want to say the pattern is broken is because if you look what the market did on Friday, it basically was like flat. So I think in a benign oil market, the S&P can kind of trade on its own. It was not able to trade on its own really. This day it had some issues. The point is, oil needs to kind of stay on the bull side. If this starts getting ugly again like this is what I think got people worried about that kind of credit crisis when I showed you the HYG, because a lot of oil and gas companies have a lot of debt to fund their actions, and if they can't sell oil for a premium, they're not making money. They're basically servicing debt at best. I gave the example at the time a few months ago of the old-time experiment with the mouse and the bell, where if you put a mouse under a glass or whatever, a bell, it'll breathe normally for a little bit, and as the oxygen supply is used up, it will breathe heavier and heavier, meaning, in this instance, pump more and more, thus depleting the oxygen faster and faster. Meaning, oil companies, as the price of oil goes lower, pump more fast and furious to sustain their debt loads, and in doing so, flood the oil market and basically self-perpetuate the problem. I think a lot of these companies, when oil was able to rally up and hang up here, were able to hedge a lot of their books in the 45 to above area. I think all these companies are pretty much in the clear, so I don't know if you're going to see as violent of a move in the credit markets if oil comes back down. 200 MA has been key. It's possible we get down there. We'll see. 45 is a very key area. This reference support here, 43. So 43 to 45 is the first line in the sand. If not, we get down to 41s. If that fails, we're talking Fibonacci levels. 38s and 35s. If that happens, I don't think the market is going to like that. As long as this descent is kind of controlled and we're just working off some of the big move more by time than really by too much price, I think that there can be a rally. I do think we're in a channel here, and we probably do get a bit of a bounce. I don't think this is just going to be a complete, collapse, but oil is trading a little bit weak. I often talk of the better way to play this is with XLE. The good news with XLE is it's still showing some decent strength. It hasn't really fallen apart here. You have double bottom lows here at 60. This one was 66.37. This one was 66.35. I guess a slight undercut, but close enough for government work. 50 MA is real key here. Also the 200, like I said in oil, this has been a very key level. Let's use 50 MA and these reference lows. If you were to take out like these 1, 2, 3, 4 days worth of trade, really more, because you have these, it's like 7 days is weeks worth of trade. I think we would see that 200 pretty quickly, and maybe some of these fib levels. I'd be looking more to buy these via short out of the money puts than I would be to kind of get panicked. But, I'm mindful of these levels, and I'm mindful people are long XLE, and we use stops in my part of town. Pretty bad Western, anyway. So these lows, if we take them out, it's a right or right out short for a play down to fill up the triangle down to probably 63s, maybe even 61s. If this holds, the play remains to the upside. We are kind of breaking a little bit of trend here, just kind of trading on the back side of it, so it's not really conclusive yet, but my radar is in caution mode. One of the other reasons I'm in slight caution mode is Exxon. We are at the upper end of the channel. We are on the back side of this kind of informal progression line that I've drawn in. I do believe Exxon is going to see higher. I've said I think it's going to see a hundo again at some point, or very close to it. But we could see a pullback first. 50 MA, very key. Channel low, very key. See it held here like a boss. Came up, new highs. I mean, we're basically near all-time highs, but Friday, a lot of relative weakness. Thursday weakness. Friday, really not much of a recovery, just kind of chopping. That's okay. I'm fine with a little bit of consolidation in Exxon, but to my eye, it lagged a little for a couple days. Let's watch this range. You have 1, 2, 3, 4, 5, 6 days worth of trade. If you lose those lows, 92s, 92, what was that, 92 quarter, 92.35. If you lose that area, I think it's going to be a right or right out short for a move down to the channel low. If we can hold that and extend, it's just to me a hold. I think it's bullish. I'm long a little bit, but a little less long just because of out of the money puts expiring. I also, if you take a look, drew in took the liberty of drawing in a larger term channel. We're getting kind of close to the top. It doesn't necessarily have to be an exact touch, but as we move into this kind of wedge up here, I am looking to book more and more profits. That is my story, and I am sticking to it. China. As long as we're not in crash mode, I'm okay with China. We are in a tentative recovery mode with a kind of starting to move upward channel. 200 MA has not been sustainable. Moves above it have failed. We are kind of just futzing around. I think this might have been a slight close above. Oh boy. 50 MA, really the key, and channel low. If we lose that, we could retest these all-time lows, which would not go over well. If we can take this high here, 35, I will be thinking that the lows for China could be in. As crazy as that sounds, that is possible. I'm just playing it with the channel. Keep it simple. This is on the fly. I hadn't been planning on talking about BABA, but when I think about China, I think about BABA. That kind of sounded a little wrong, right? Anyway, 77, very key level here. You can see that area has held. You have a 20, a 10, and a 50-day confluence. 200 is moving up. This is in a major consolidation pattern. If this can break above, I think it's got some legs. At some point, I think Baba sees a hundo again. If it were to take out these lows, don't. It would not be a pretty sight. I think Baba would be in a lot of trouble because this has had multiple distributions up here. You can see all of this. This is why it's just chopping. You had all these people who bought and were wrong, all these people who bought and then were, subsequently wrong. It doesn't feel good to be wrong. The only way to be not wrong is to either be flat, meaning get your money back, or to be right. And my view is that this is just spending some time kind of gathering itself. The IPO was a great success followed by a complete flop. So this to me is changing user bases. This is building a following. That's just my view. It's just consolidating. If you really want to own this, wait for the down moves and sell some out of the money puts, but be mindful we are in a range, and if you start losing the 77s, that's the first warning, and the 75s, it could be some rough sledding. Rough sledding. I like that. IBB. I really don't know what to tell you. We have a range. I've thought for a while we might want to come down for the 100% retracement and the 1.618 fib extension from this move. It has not cooperated. I wouldn't say I was wrong here because I did talk about this head and shoulders setup and the check back as a short, and I think the rest was pretty much history. You had a wedge. You had a false breakdown to range low, which held. Now you're back up into range. 275.40, 271.77. Anything below there to me remains vulnerable. I'll even just say the range high here because look at this. This is really a range low, and this is really a range high into 289s with a 200 MA. So until you really get through there and look where these lows were, it's just to me looks like it's, I don't even know, just consolidating. You really got to wait for a range break. If you get this snap here, this is going to come all the way down. And if this can hold, you'll probably double up the range and come up for the gap fill. I'm just going to keep it that simple. Wait for the range breakout. I will caution this because not all breakouts are created equally. I think the reason this one failed was because you would come down basically from the range top straight in a straight line to the range low. If you rally again in a straight line to the range top, and there's a breakout, you probably want to be more of a seller of that breakout than you do a buyer because it's already moved. It's come up from the bottom. The best thing this thing could do is kind of like chop sideways for a while and then just start gradually going up. All of the real big money is made kind of in the end of the moves anyway when things get parabolic, like you can see here. This was just this gradual grind and then things kind of started getting exciting. So I would be a little cautious if this comes back up. It could even be a right or right out short at the range high for at least for a pullback near the 200 MA. That's my thoughts on IBB. Gold. A lot of talk about gold. All that glitters is gold, right? That's that Smash Mouth song, I think. I don't know, whatever. I'm not really that into crappy music, but whatever. The Fibonacci levels are not right because gold has moved up, and I haven't adjusted them. 131.15. We'll adjust it on the fly. How's that? So I don't necessarily know that this is going to be the top in gold, but I will show you this. 5 years, the weekly, there is a down channel in gold. We have come up quite a ways and getting close to it. Yeah. I would probably be looking to book some profits in gold a little bit too, particularly if the dollar starts kind of getting jiggy. I do think gold, it depends on your time frame. If you are immediately in gold, you probably want to look to book some profits at the channel top and the downtrend down channel line. This really should be in yellow since it's a secondary. I like to be consistent. But I think longer term, gold is probably going to break out. It's going to break this this channel here and go a lot higher. But I'm just cautious short term because we did get a channel low test and we're basically coming up with, I guess, some pullbacks. But we're getting up to close to the channel high. That's just sort of me, the trader in me. I like to book, when we get into some potential resistance areas. I did start booking some profits in silver. I will say this, what augurs well for gold is silver didn't stop at the channel, and it did punch through, and it's holding up quite strong and looking like it wants to go quite higher. So, like I said, I am bullish on both of these. I actually like silver. Let me tell you, when things get jiggy, silver outperforms gold because it's sort of like the levered version. It's the poor man's gold. A lot of, I don't want to use any derogatory terms, but let's just say people with smaller accounts. More the gambling variety has that. This is forming what looks to me like a large rounded bottom and looks like it wants considerably higher. I will be looking to buy dips in silver. If we can be so blessed as to get a 50 MA touch, I would be an interested buyer. The first and foremost would be a backside of the channel test. That should be, at the very least, a day trade, right or right out long for a bounce. I like silver. I sold a little early. I still have, I still think I have some, but I probably should have more because I have been pretty bullish for a while. I had really good trade location on this. I bought this thing down in the 14s. So to make that kind of a move is good. Anyway, silver, gold, both bullish. Buy the dips. I would really rather not be a chaser in those names. SPY. SPY. All right, so we're getting kind of close to the all-time high. Let's zoom in a little bit more here. I realize this chart's a little bit messy. I did take out some old levels that I didn't think were as relevant, but the good news, at least for the bulls, are if you X out these couple of days, this was starting to form. Let me draw it in just because not everyone has the imagination that I do. This was starting to form what could have been a head and shoulders pattern, and I said if this were to really fail, it would have stopped, I think, here for a lower shoulder right around the 108s, the high one, like 109. It didn't. It eclipsed 211, which would be the left shoulder. It also eclipsed the head. So the head and shoulders pattern is once again not on the table. It is officially retired for this move. That doesn't mean the market can't pull back. It has, remember when I talk about coming up from the bottom, but if the market were to ever have a blow-off type of move, it wouldn't surprise me for this to be it, and I'll talk about why for a second. This was the pre-Brexit move. That day had taken out more than one. Basically, I don't think it took this high. So it took out 1, 2, 3, 4, 5, 6, 7, 8 days worth of trade. We closed very rich here, and it did close above range, and it fell, and it did actually go higher in the after-hours market. Remember when I talk about highs not being made in after-hours? They usually happen RTH. You had the Brexit, and you had this very, very, very large liquidation break. I want to talk about technicals for a minute. Yes, you had lower highs, and yes, you had lower lows, but, and this is the big but, and this is sort of where the nuance and the true technician comes into play. It didn't last long. Look where we are. We're now over those highs. We're over these highs. You're at some channel resistance, I guess. I really should redraw this in because this could be a little bit higher. I will do that at some point. My next chart will be updated. The story here is that when a market has a liquidation break, when you're in a true bear market, you get a move like this and you don't recover fast. You get a move like this and you get either a small bounce or you go sideways with no recovery and then continue lower. This spent 2 days dumping, and then 3 days, 4, I guess, recovering almost all of it. That isn't the characteristic of a bear market. That's actually the characteristic of a bull market. But I'm not really willing to say we're in either. If gun to head, I would say we're more in a bullish tape than bearish tape, just based on this price action. You had now this move. You had 1, 2, 3, 4 days of consolidation. Remember, I talked on Periscope above this high was a right or right out long. You had an opportunity. This was a gap and go day. If we got below, I said it was going to be right or right out short to the downside, but it did break to the upside. Not surprising. That was kind of my bias anyway. I talked about the 50 MA holding here. I talked about the body of this pullback bar still holding over the moving average. You just had to look below in the wick. This, when you have a doji day and it closes near the high of day here, often you get a move resolution higher. If you do lose that low, it's either a good place for a stop or a right or right out short. But it moved to the upside. If you look, I have drawn in some potential for what an upside move might look like. We now have a channel. I didn't use the wicks here. I used just these to be conservative. And this was kind of unsustainable price action. Would not surprise me to see this rally up and get the full 1.618 Fibonacci extension of this Brexit move. The 1.272 is up to 216.29. The 1.618 is 212.09. That would be a really big move that I don't think a lot of people even would consider possible. I'm not necessarily saying it has to happen like that, but it seems to me that we have now spent a lot of time testing these highs for the better part of a few years, and the Brexit, which was supposed to be the end of the world, didn't collapse the market, and we are now, we did make a lower low on the Brexit, but like I said, it was a cigarette's length. I said if you went for a smoke or to use the bathroom or whatever, to Chipotle to get a poopy burrito, you missed the entire move. Anything, in my view, above 211, above 212.52 has to remain bullish. I really would start getting, you could have a pullback here. It wouldn't surprise me. This is kind of what happens. We get a lot of these tests of these important levels. But as long as 208.97 really holds, like if we were to get a retest of the backside of the old downtrend line, I think a lot of people would be very bearish, but it wouldn't surprise me. I still think that's really the delineation I have of the upper distribution now, 208.97 to 211. Anything above that or in that, I think remains bullish. I have to say, it just seems to me like the market does want to go a little higher and kind of squeeze a lot of people. When we had this false head and shoulders here, while we were pre-forming it, while we were forming it, after we formed it, Brexit, the same people that were short and bearish and adding are now all wrong as of the close on Friday. And if you know how I talk about thinking like a machine, it seems to me that the pain trade is higher. I don't know how much higher. I've proposed a potential new channel, and some potential Fibonacci extensions. But it seems to me like the machines are going to probably, at this point, since we got through this high, make a run at the old all-time high. And as I always say, see what's doing up there. See how many stops they can get. See how many longs they can suck in. It just seems to me like the market does want a bit higher. If there is an early pullback, I'm okay with BTD as long as this area holds. The failed right shoulder was 208.54, so I'm using that as kind of like a little give, but really 208.97 to 208.54, as long as we have pullbacks that hold there, all-time highs are still in play. If we start getting below there, then I would start saying that this move is just as false as this was. This one might be as well. But as of now, I will stick on the era of the higher. The expected move for this week is $2.72. That would take the market to 215.37, which starts getting close to here, or 209.93. And if it is a move down, I think that number will probably go up because VIX will go up, and that would probably take you down to close to the 209. So that's my view on, on SPY. What do I want to show you? XLF. XLF still hasn't broken out. It had a bit of a breakdown. We didn't get the full 61.8, which really would have been kind of the neckline test of this inverse head and shoulders. Kind of the meat of it. And now we're back up right to the 200. I really don't. I think that there's better ways to make money than in these financials. My real beef with them is that they've been really regulated badly with Dodd-Frank and Sarbanes-Oxley. I mean, just over the years, the ability for these businesses to make money has been crimped. And with low interest rates, they aren't able to borrow cheap and lend expensive. They borrow cheap and then lend cheap, and they take on a lot of credit risk. That's why it's very hard to get mortgages and loans these days. It's just a utility in my view. If you start getting these things with 4, 5, 6% yields, I think you can just hold on to them in an account for a while, dividend reinvestment program, and eventually when interest rates go higher in X amount of years from now, these will be big winners if you want to play it as a utility play. But I just don't see these things having crazy price appreciation. One thing that I will say we have to keep an eye on that could be slightly optimistic is the Morgan Stanley. If this can get above the downtrend line, I might start thinking about revisiting my view on financials. Really above the downtrend line and above the 200 MA, this area, the 28, 29. I proposed a neckline. We've traded on the other side of it and then below it, so I don't know how valid it is, but I do like as long as we're above 26.16, I'm a little bit more bullish than bearish, but it's still in a downtrend. It hasn't broken. Just wait. You gotta really see a downtrend break. These businesses are cheap. They trade at single-digit multiples, and I get it. It's gonna take a while. You're gonna have to just be patient if you want to play that. Deutsche Bank, same kind of thing. There's a lot of talk here about this having credit problems. I don't know if it does or it doesn't. My guess is that it's probably more fear of currency exposure, loan books maybe, but I really think it's just that they can't make money. With negative interest rates, like I talked about the U.S. banks who are struggling with, ZIRP, zero interest rate policy, and like low single-digit interest rates. Europe is in negative rates. I don't know how these guys are, I think the fear is that they're not going to be able to keep the lights on. I don't know that Deutsche Bank's going to be a zero. I don't think that's the case. This is probably going to set up at some point for some kind of like generational low. We are below the one channel line. We're coming kind of close to the next. This could be a single digit at some point. I don't know, but I do know this, that I don't think that this is a zero. I just think that they're struggling to make money, and that these businesses are just not great businesses. On the other hand, a business that should be doing very well right now is Ambach. For those of you who haven't worked in finance or haven't been involved in financial markets long, Ambach basically insures bonds. If someone wants to issue debt, and this should be the golden age to issue debt. Everyone wants to issue debt with low interest rates. You can change your entire capital structure and benefit from, like I talked about, a very low weighted average cost of capital and lock in interest rates for low interest rates, sometimes sub-government interest rates for a very, very low time. This is the company you would go to. If you have a junky credit rating, you would pay them to use their credit rating. This company used to mint money in the early 2000s, 90s. What has happened on Wall Street before will happen again. A lot of companies are looking to issue debt. This just is breaking out of a very, very protracted downtrend. It looks to me like it is forming a rounded bottom, building up a base. 200 MA is the key for me here. Look at the resistance. This has roughly been some support, but look where it really broke down from. Once it got below the 200, it couldn't recover it, and down it spent some time chopping, and it has loosely been holding the 200 MA. I'm using this range low, below 14s as my stop. I would not be happy to see this kind of sink back down to the lower part of the range, but I am nibbling in this. If this were to break out above the range, I will add to it. I think that this could be a play for multiple months or years as companies look to them to issue debt, but we'll see. It's just a thesis. It may or may not play out. I haven't bet the farm on it, but I am interested in that play. IWM. All right, so I'm going to keep this really super simple. 114.29 is the low of this box. As long as we are confined within there, it's kind of okay. If you get below there, it's not as okay. You just had a downtrend break. We basically roughly held the channel. Look at this. This low held the backside of the old downtrend line, which is good. I like price action like that. And it was a higher low than here, which a slightly higher low. Nuanced, but important nonetheless. We're now coming back up. We haven't taken these highs like SPY has, so it's not as good. But if we were to have a strong dollar, theoretically, businesses that operate inside the United States would benefit from that. IWM, choppy, kind of messy, but looking better than not. As long as we're in the box, I will remain optimistic. If we get below the box, I will be less optimistic, kind of like box ball, for those of you old enough to even remember when that game was played. Jeez, I'm feeling old, and I'm not even really that old. Qs. Also, hasn't made a new high here yet. It's still slightly lower highs. You had a false breakdown, recovery. To really get under the gun in Qs, you really need to break the 104 to 105 level. You had a brief break and recovery. This is going to depend on Apple and Google and that cohort. This box is a little bit bigger, so I'm not willing to, and we're not as close to the range low as we maybe were here. But I'm kind of, I don't want to say I want to take a punt on this. Tech doesn't tend to do well in the summer. I mean, we're not quite at the end, but I guess we're getting close to the end. You really need to see it take this out, and this could maybe form the W pattern if Apple were to get busy to retest the old all-time highs. So I'm just watching for a quick little trend break and a break over these highs here, the 110.63-ish, 110.75. A break there, I think, easily would see the 111s, and I don't necessarily think it would stop there because these highs are all really close. And I think you would, like I said, the machines like to see what's doing above. Think like a machine. The expected move this week in Qs is about $1.51, just so you know. So we might not get too much resolution this week. Speak of the devil, and they shall appear. I probably could have done a better Bane impersonation with that one, right? But anyway, after my failed cowboy impersonation, I'm not going to embarrass myself twice. This chart is really got way too much going on in it. I'm going to have to adjust it at some point. I don't really see a lot going on with Apple here. This quarter isn't really the best. If they run it up into the quarter, it's probably going to be a short. If they dump it and they do what I really am hoping they do, the shake and bake, where we get some panic, everyone thinks the iPhones are going to be crappy, then I think it's a buy. I think regardless, after this quarter, there will be some strength in Apple because you have iPhone 7 coming. I also think Watch 2 is going to do a lot better than Watch 1. I'm seeing a lot of people now starting to wear the Watch 1. I live in New York City. I guess it's a trendy fashion town. I am noticing more and more people wearing it, and that's good. I myself I've been waiting for the kinks to be worked out and for better battery life. I have also spoken to some Apple employees. I have friends who are Apple employees, and they have told me that they are hearing the same thing from a lot of customers, and some of them themselves are waiting for the Watch 2. I think that's going to do well. I think the iPhone 7 is going to do well, better than people seem to think. And that's just how the stock trades. When you get an iPhone launch, you get a rally. So we just have to kind of get through this quarter. The IV in Apple is really low right now. If you must play this, the best way to do it is probably to sell some out of the money premium. Right now, it's pure directional play. The IV is cheap. If you're bullish or bearish, buy this calls or puts right now. They are super cheap. 26, 25 IVs is cheap. When it starts getting into the 30s or 40s, which would be a gift, it tends to be where you want to be more selling premium. This did have a head and shoulders breakdown, a failed check back. Pattern is still overall bearish, but if any stock were to defy the odds, it's usually is Apple, right? Below 103.12, and the channel is vulnerable. I think that this could really maybe just chop between 103 and maybe 85 on the weekend. I'd be more of a buyer of dumps here, given where we are in the season. I'm hoping for the shake and bake. Right here, it's sort of... I talked about this play as a gap fill. That played out well. It worked. It seems like it wants to rally in front of the number, so that might set up for a right or right out short for maybe one last move down before the end-of-year type of a rally. But right here, it's really no touch. I honestly think there's better places to make money right now than in Apple, as sad as that might be. One of those places is kind of my BFF, Facebook. It did not disappoint. I talked about this. A rally, consolidation, the freak out, then the rally. Rally, consolidation, the freak out, and then the rally. Who could have predicted this? I don't know. But I talked about it. I played it. Came, I saw, Vine, Vide, Vice. Came, I saw, it conquered. Worked out. I bought it. I kind of bought the pretty much dead low. I sold a bunch of puts, and it rallied. I love when I get in trades, and you have a secure low here, by the way. This is a secure low setup, although kind of a secure low light because we were there before. But it was a trend touch. You got the gap fill. It went well. This day is your key day. You could see the next day was a very minor pullback. Remember I talked about the doji near the top of a range of a stock, and then Friday was strong. My guess is that this is going to rally into the number. If it rallies too much into the number, you want to book some profits into the number. If it doesn't and just chops sideways, you will reevaluate when we get there. We have a bunch of days. I like to see where price is at the time. It is very important to me. As far as Facebook's business goes, I think they're just killing it, man. I think they're taking market share from Google. I think they're taking market share from everyone. I think there was the move to online and now the move to mobile and social, and that is Facebook's wheelhouse. I think when Snapchat comes public, that is going to show just how valuable Instagram is and how valuable Facebook really is. I think I know it's trading at an expensive multiple now, but it's amazing how quickly they can turn on flip switches and so on and so forth and make billion-dollar businesses overnight. At some point, that'll all end, right? But this could be, I don't want to sound crazy, but this could be a lot higher, like a lot higher by the time that something like that would happen. If you want to talk about Fibonacci extensions, I'm going to cheat a little bit to draw it. Alrighty. This was what, 120.79, 108.23. Let's just take this out. Throw in the 1.618. Let's take out these meaningless ones for this purpose. If you use the latest range, the 1.618 Fibonacci extension is 128.55. I did it once before from another level, and it was 130.43. That's where I think Facebook is going. I just don't know that we don't need to have a dip first, but longer term, I am positive on the Facebook. Amazon, I talked about this in the last weekend video that I thought Amazon was going to go to new highs. that it looked bullish to me. It held where it needed to, and Amazon closed Friday at the all-time high. There's a channel here. It can potentially see there if you do a 1.618 fib of this entire range. 833.91. It could happen. Anything above 731.5 is bullish. If there is a pullback, mid-range is where you want to buy. So roughly somewhere near or around this gap fill in the 700s. Ideally, that would happen maybe before the earnings. If this just completely runs into earnings, it might set up for a blow-off or a short, depending on how steep the action is into it. We'll reevaluate when we get there. But Amazon's a pretty bullish pattern. That's also when I talk about AI and automation and changing patterns of consumers. You can buy stuff on your iPhone. It's really dangerous. If you're out at bars drunk, you can wind up buying amazing amounts of things. I wouldn't know about that from personal experience, though. But I will tell you this, that Amazon is how people are buying. Going into a store and being treated terribly by incompetent employees is thankfully a thing of the past for the most part. This is the wave of the future, and these guys have just dominated. I just don't think people had the vision to see where this company could go, and they are doing it. Bezos is just killing it, man. He really is. My hat's off to the guy. Netflix. Alrighty. So there was a lot of upgrades and downgrades and whatever. This was a look below and fail. Secure low light, rallied up. This got a little bit sporty on an upgrade here, right into some resistance. Closed below trend, backed off the last couple days. As long as you hold 92s, 93s, I'm kind of okay with Netflix. You have earnings coming up. This is going to move big. I really hope it's a big puke down, because this I would love to buy closer to 70 near the trend, near the primary trend line. Maybe even, God willing, an overshoot and get one of those really big. Anyway, that's probably not going to happen. Netflix is, the new kind of gold standard. At some point, their growth will slow. Doesn't seem like that's happening right now. I'm a little cautious on Netflix, just because it's still making lower highs and lower lows. Once that pattern can change and it starts making some higher highs and some higher lows and higher highs again, then I'll be a little bit more of a fan. Anyway, it's sort of a Costanza stock. You do the opposite. You buy the dips and then kind of sell the rips. I do like that it's consolidating under the downtrend line. I would be surprised if what would be the ideal scenario would be for it to kind of just consolidate here, and then on earnings either have the big gap up, which is sort of the professional gap, which kind of gets the move going again, or if this were to move up aggressively ahead of the earnings and set up for a right or right out short, like it kind of gets the move it's supposed to have ahead of time, and then it kind of backs off. I want to see where that is ahead of the number. When we start getting close to earnings, I kind of like to be the second mouse. Google did get the 682 I've been looking for. This is a island reversal, a morning star. Pretty bullish pattern. However, it's in the context of chop. So it's still making kind of lower highs. It's still in a downtrend. I really would have loved this to come down and retested the primary channel, this kind of like secondary and tertiary channel, and set up for an amazing long here. This quarter doesn't tend to be the best for Google, the summer one. I'm a little bit cautious, particularly if this continues to run into it. We'll evaluate there. I really would actually rather play Google for right after they report. It's a big stock. It can move a lot. This one I kind of like to play the second mouse. But if this does really run hard into here, I might try a right or right out short. We'll see. If it dumps and gets my confluence, I might try a right or right out long. All right, let's wrap up soon. We just have a couple more of these tickers to go. Tesla, I'm going to keep it simple. This stock tends to do well in the summer. Elon Musk did that Solar City thing or whatever. It's held the key supports it's needed. This really needs to break the downtrend. The ideal scenario for this would be sideways action and then a gap and go on their numbers. We'll see how that plays. This tends to be a bullish stock in the summer, but it's been muddied a little bit with the Solar City thing. So I kind of, when in doubt, I kind of just step aside. This held the 205s, it rallied, then it held the 191. This was the key area. If you didn't buy here, which I had said is a good area, you probably, or if you did, you want to book some profits here. If you didn't, you kind of want to just wait, I think, and see what happens after this number. The stock is probably going to move a lot. After that move, I think that there will be continuation either higher or lower. If this were to break again down, I think that the stock is going to have a considerable amount of problems. If it does break up, I think it's got quite a bit of legs. So there will be money to be made post that move. I'm going to finish on PayPal. This is another one that I kind of like. Look what it did. It kind of just has been pulling back. It got a little bit of a look below and fail here. This had a 3-day down, 1 day kind of up, consolidation right under the downtrend line, and then you had a gap and go on Friday. It is technically right into some resistance, so this might not play out so quickly, but I do think that this stock is probably, famous last words, right? But I do think could be destined for higher, maybe 38s, maybe even 40s. It just seems to me like they're kind of in a good place, that this could be a buyout target at some point. Obviously, I don't know anything, but I do think that the stock wants to go higher. I had meant to take it long, believe it or not, on one of these days. I'd been looking and looking, and I guess I was preoccupied with some other stuff, but I did take it long here, and it is paying off. I'm a little bit green on this one. If we were to lose this low, I think we'd get the gap fill quickly, and I would be a little less inclined to be bullish. The ideal scenario, I know no one likes to hear this, it would be for a couple of days of consolidation, not taking out more than half the day, and then going. That would be really great, because it would kind of hold, like we use the 3-day rule sometimes, get a couple of days here and then go, and then I think it would have some real legs. Anyway, that's my story. I'm sticking to it. Geez, we're over an hour. If you're not following me on Twitter, my handle is @JustinPulitzer. If you like this video, hit the thumbs up, leave me some comments. I always like some feedback. Let's have a good trading week, and cheers.